All right. Well, thanks for joining us today. We have a webinar which I think is going to be applicable for a lot of our audience. And, it is on a topic that maybe a lot of people are maybe not so eager to learn about, and that is accounting. And we're going to try to break it down today in a way that is interesting, that is broken down into chunks that are digestible and really applicable for MSPs in particular. And we have a great guest today who's going to be joining us. It's Paul McCann from Earth CPA. And let's get right into it. So if you're on this webinar, you're probably familiar with the host broker, but if you're not, you can check out our website. It's thehostbroker.com. We were founded by Heartland Ross, and we're an M&A and advisory firm and business brokerage for IT service providers. And our guest today, as I mentioned, is Paul McCann from Earth CPA. Paul has 23 years experience guiding small businesses through financial challenges, and he founded Earth CPA to help MSPs, particularly with client success. And he's dedicated not only to providing just reports, but also actionable insights. And Paul, thanks so much for joining us today.
Thanks for having me, Devin.
So, Paul, obviously our audience is largely skewed towards MSPs who are interested in M&A, both buyers and sellers. And so I thought just to start off the presentation today, we could discuss a little bit about what the benefits are to preparing your financials and a firm's accounting before actually exiting a business. So I'm sure this is something that you've seen before in your practice, where perhaps you have an MSP where their books are not particularly granular, where they're not able to break out, revenue and COGS by service type, etc. Can you speak to this a little bit in terms of what your experience is like, with MSPs who maybe don't have their books laid out so nicely?
Yeah, thank you, Devin. I'm looking forward to talking about this. I like to frame this conversation and really accounting less about accounting and more about your business. And as we talk about this concept, I really want to talk. I really don't want to talk about debits and credits because that stuff's really boring. And all of the knickknacks and the little taxes that have to be filed and all that is a very that's in the weeds, and I don't want to spend too much time talking about that. What I do want to talk about is I want to talk about Beachbody financials, and what I mean by that is there's Beachbody. There's a whole host of workouts designed to get people in Beachbody shape, so that when you go to the beach and you are in your swimming suit, you can feel confident about that. So I talk about Beachbody financials. And when you're putting Beachbody financials together, you are creating your financial statements that really only a few people see. I mean, let's really be really honest. You're sharing with your banker if you have one, your business partners, and any financial partners that you have. But most people don't see your financials. When you go to sell, however, that's a completely different story, and a lot of people will have eyes on it. So the question, I think, Devin, is, do you plan to sell? And we have that question, that conversation from the very first discovery call when we talk with somebody. You always plan to sell. At some point, you do want to create value, and you want to capitalize on that value, whether it's an internal sale, whatever you end up doing. Eventually, the time will come when you're ready to capitalize on that value that you've created. So do you want to run your company as somebody who runs a real business and who understands their profitability, where things are your financial system is running as it's on rails, or are you going to be satisfied with a bookkeeper or an accountant who maybe not stay in the job as well, or maybe not do things the way that they need to be done, and not really understand that process? So it's really the question of, can you get your business into Beachbody shape so you can capitalize on the value when you go to sell, or is this a constant struggle that seems like we can never get ahead, and as soon as we get ahead, somebody turns over in that process and then puts us back by some amount of time not able to get where we need to go.
Yeah, I like that metaphor. I might have overlooked those beach body workouts myself, but I like it as a metaphor here. And kind of going to this idea of the fact that, most of the time your financials aren't going to be viewed by a lot of people, but when you're selling, it certainly will be. I mean, when you're selling, often we have dozens and dozens of inquiries, and every one of those groups is receiving your financials. And so it goes to the first bullet on the slide here about encouraging buyer confidence. If we put ourselves in the position of a buyer, they want to have as granular information as possible, especially around the revenues and the COGS. So sometimes we see things like, if the recurring revenue is kind of one bucket, but it doesn't break out, let's say, software subscriptions. Obviously software subscriptions are much lower margin than, the labor component of a recurring revenue bucket would be. So not having that broken out, it isn't going to give the buyer confidence about how much the business might actually be worth. So just tying it back to M&A there, like just having your beach body ready for to be seen by all the beach goers here in the metaphor of in other words the buyers is really helpful. And then just go to the second bullet here of easier due diligence and transition. One of the things that we find is, and I know that, Paul, you've mentioned to me offline that you get asked about what does the due diligence period look like from some of your clients too. There's a lot of questions get asked of sellers during the due diligence period. Um, and it can cause a lot of delays sometimes when that information isn't necessarily available, where other MSPs might already be able to break out the information because they have their books in order. Um, so I don't know if you have any thoughts on that particular point or any experience, that you could share here, but
Well,
just the, go ahead,
sorry,
sorry.
sorry, Devin, I don't want to interrupt you. Along those thoughts, if we're going to talk about the due diligence, but if I'm going to sell a car, and I don't regularly do this. I was talking to a friend of mine who recently sold a car, and he sold it very quickly and at the price that he wanted. I said, well, what did you do? Did you do anything differently? He said, I just took a camera and went through every problem that I had in my business or in my car, and I looked at the problem areas, did a video, showed pictures of everything that a buyer would want to see. And I thought that was a really great analogy for the accounting, because oftentimes sloppy accounting can cover up problems. And if things are done really well, you're talking about giving the buyer confidence when it comes to really putting your system in place. And just like a friend of mine who sold a vehicle, when you can show a camera on an area that isn't necessarily isn't perfect. So if you can show an area that's not perfect, that increases the trust between the buyer and the seller. And we all have areas in the business that aren't exactly perfect. And by getting to the level of detail that you're talking about, Devin, we're really saying, yeah, my software subscription revenue, I could probably bump that up, and I could probably be closer to best in class on that. Or my margin over here is not as great. And what happens is when they put that in a granular format, you can very easily see where the business stacks up. And what that does is it allows the buyer the confidence to say, well, all I have to do is adjust this and they can understand where they're going to create value if and when they purchase the business. But they can't see that until they have that level of detail that they need to have. And it's really just that transparency of being able to say, I'm selling this business. This is exactly what I'm selling. I know all of my ducks in the order, and there's a few things that might be a little ugly in there, but at least I'm showing it to you.
Yeah, 100%. And similarly, when you're in the due diligence period, if there were things, the problems that you were covering up, those are going to come out at that time because that's when your financials are really going to be scrutinized. And the last thing that we want is for a deal to come under LOI and due diligence starts only for the deal terms to change. That's not good for the buyer or the seller. So, having that transparency up front and the granular reporting, it really helps there. So the last bullet on the point on the slide here is just broadening the buyer pool. So one thing that we see quite often is the the larger buyers, the more institutional buyers, they have processes in place. They have specific bits of information that they're looking to get from sellers. And smaller MSPs often don't have their books set up in a way where they're able to provide the metrics that are being requested. So it just, by having all of your finances, your accounting all set up nicely, it is going to broaden that pool of buyers that are going to be interested in your business. Okay.
Definitely want to speak their language, right? That's the gist of it. Well, let's get in the language of what the buyer wants. Let's put it in the terms that they want to understand, and they ultimately care more about accounting than they probably ever have been before. Like a lot of sellers will, or a lot of people I've worked with may or may not have a strong interest in accounting, but by the time they're ready to go to market and talk to Devin, by all means, they're going to get a lot of questions about accounting that they may never have had.
Yeah. And it depends on the buyer too, right? Like the say smaller buyers that are existing MSPs themselves, they don't have as much as many questions financially. Usually, it's more about the operations, what's your tech stack, etc. But when you have that more financial institutional buyer, it really is hyper focused on the finances. So Paul, I want to give you a chance here. You've developed this model called the finance flywheel, a flywheel rather, which is on the slide here. We're going to be going through each of these the components on subsequent slides, but can you just introduce us to this concept of the finance flywheel?
Yeah, thank you. This is the finance flywheel came about as I was talking with many of my clients, and I was describing a system of the business that, if something's not repeatable process, then it's not really a business. If you can't, leave it and delegate it to somebody else, well, it's not a business, it's a job. And as we are looking at creating systems that create value for the client, I ended up talking quite a bit about a flywheel. The flywheel is this idea or this piece of machinery that has been around for over 100 years, where if you get it, it's usually very heavy and it spins around, usually at a decent rate of speed that spins the motor in an old piece of machinery. And when that flywheel moves, it creates this process. It's very difficult to get going, but because it's so heavy, it can continue to work and it continues to spin. And I was talking about this with several of my clients, and I said, we really want to get your financial system to work like a flywheel. Once it might take a little while to get there, but once it's up and moving, it's going to continue to turn. You're going to be able to put people in there, and when people come and go from your company, that system and that flywheel will continue to work as it continues to move forward. And that financial system, this financial component of your business, is really a critical area of the business and a critical component of the business, and that needs to work in a repeatable, systematic fashion, just like a flywheel.
Well, I like the metaphors today, the flywheel, the beach body, the car. So we're
I'm pretty
doing
sure I'm the
well.
only one using Beachbody financials, by the way. So
All right, well, let's get right into it then. And we do have a slide for each of these components. So first off, we have clean real-time data. So can you just talk to us a little bit about how this is represented in the flywheel and what how MSP should be thinking about this?
yeah, I mean, there are, we've talked to some people who have had trouble getting their tax returns done on regularly, or because their accounting system's not closed out for the year. I really want to get down to the micro on this one. I don't think it needs to be, I think everything needs to be closed on a monthly basis, but I even think that's a little too slow. I use QuickBooks Online primarily in our practice, and we have a bank feed, a data feed that's going to come right in. So when things clear at the bank, they clear in the accounting system as well. And we practice daily accounting just so we have a good idea of what's happening. Um, so what we're really looking at is we're getting that level down to real time. Might be for accounting systems, real time is daily. It's not exactly throughout the day necessarily, but clearing the transactions that have cleared the bank are also up to date in your accounting file. That's what that means. And why is that important? Well, everything depends on good data. The faster you can get that data, the more in charge of your business you're going to be. Again, we're not talking about accounting here, we're talking about your business. So when we put the information for your business in your hands and say this is how your business is doing, you can then make real-time decisions, you can pivot, you can make structured, sound financial, non-emotional decisions based on good data.
Yeah, I like that. And do you mind just talking to me about this last bullet here, the mystery balances and eliminating those? So what do you see there? I mean, it sounds very it's
Yeah.
mysterious. So
Yeah, what is a mystery balance? A mystery balance is, I was talking with somebody who was looking at purchasing MSPs. I said, "What do you see in the data, or what do you see when you are looking at clients, prospects, books?" And they said, "We have a whole bunch of issues in accounting." I said, "Like what?" And they said, "I see balances on the balance sheet that have no economic value whatsoever. Shareholder loan with an who knows how big of a value might be. The notes may or may not have been paid off if there's any loans. There are sometimes checking accounts and old credit cards that are on the balance sheet still with zero value in them whatsoever." So it's not, they're just not right. And it's not cleaned up. It's just not the kind of, you wouldn't want to show that to anybody. And it's a process because it's really overwhelming for a lot of entrepreneurs. So a lot of entrepreneurs, Devin, as you know, and have worked with these people who went into business because they could solve problems for people and they were good at it. And most of our clients, or many of them, started their companies and they kind of had a superhero cape on. And superheroes don't want to sit down and do accounting, and I don't blame them. That's not what they were really good at. So they leave these balances in there, or they let it kind of you know just sit there because let the sleeping dog lie, if you will. But that isn't ready. It's not in a position where you're making a good decision based on what you have on your balance sheet or in your profit and loss. And these mystery balances, they just distort what you're trying to tell. If the accounting is telling the story about your business, if you don't have the real-time data, then the story that you're telling to anybody else, and buyer, seller, whatever might happen, is just not going to be as articulate of a story.
yeah, and I can see potentially these sorts of things can be explained away, but it's really, as you allude to, it's the story and having to explain kind of these mystery balances might just not lend credibility to the maturity of the organization. So it's probably not a deal breaker, but it doesn't help, and it just kind of introduces questions that aren't necessary. So cleaning those things up before a sale would certainly be advisable. Okay, so next one here is predictable accounts receivable collection. So Paul, what are your thoughts on how to make AR predictable?
Well, this is a separate area. If I look at the finance, accounts receivable is really a separate area. If you're looking at the daily bookkeeping or the accounts payable, you can lump some of these together. But I really like to put accounts receivable in its own area because it is such an important area of your business, and there are so many opportunities to reduce the amount of time and friction with your invoicing process, and that I don't think even most people are considering, Devin. And this is an area where you're going to provide value and you're going to create value I'm thinking of a few of the options out there specifically that connect to a PSA system that will allow for a payment portal, will allow for a pull from the client, and it will set them up where you're going to pull the information out of the bank. You're not going to rely on somebody to click and pay on their credit card. There are all kinds of options, but really what you're trying to do is reduce the friction and simultaneously increase the positioning of your services. Think about it. If you have automatic payments set up for your landlord and you know you have a rent, you know you're going to pay your rent, and they say we're going to automate this is the way we do business, great, no problem. But if you then sell a service and you say, yeah, we want terms in 30 days, all right, we want 45 days, what is that saying about you're giving your services and you're putting them as less likely to be paid than the rent? And what I want people to do is I want people to say, I'm going to pay this bill because that's how it's set up. Let's set up a system for the business owners that pushes their elevates their service in the mind of their client that they are going to be paid. And we're going to set it up in a system that when we have the invoice, we're going to be paid. There are many different options, whether it's automatic reminders, automatic payments, pull, one click. There are so many options on the market right now that weren't even here 5 years ago that there's just no excuse for taking checks. I mean, there are so many people who are still receiving checks. Business checks are still being sent, and it slows everything down, and it down to that bottom point there. Your days sales outstanding is how many days does it take to get that your AR? So it's a metric that it's a KPI that you're tracking to see how quickly you get paid, and you want to get that down. And best in class is down in single digit days. We want to make sure that you are the client is in a situation to elevate the service and their clients, and also make sure they're getting paid. And it is such a process. Collections can be so expensive, and lawyers going after that, however you want to do that, or dealing even with 90-day plus AR and whether you're going to write it off. Those conversations take so much time and they take so much mental energy. And there is another way to do it. There are more opportunities and there's a better way to get paid. But we just requires a little bit of change in the way that you do business, but it really pays off.
Yeah, and so what do you typically see, or I'm not sure if you have a recommendation around when MSPs should invoice for relative to the month. So, I mean, most often we see invoices are sent for the upcoming month ahead of time. Is that what you would typically recommend as well, or and what sort of cadence do you
Yeah.
recommend, like when in the
Yeah.
month?
Devin, I'm glad you asked this question because you're not in the banking industry. You're not a lender. When an MSP is working with their clients, I'm sorry, Devin, I'm not talking to you. I'm talking to the listener here. If you're running an MSP, you are not a banker. And when you are extending credit, simultaneously paying for your services in 1 month and extending credit to your customer who's going to be paying in, let's say, 30 days, you are taking on the risk of the spread between paying for your people and paying for potentially if you're paying 30 days late. Best practices that I see are exactly what you're talking about. They're invoicing on the first of the month for a managed engagement. They're for the first of the month before any work has been done. That covers all of their costs, their labor, their software costs to be able to provide that service. Get that paid upfront. The absolute best practice is where there's a pull and people are being invoiced and it is being pulled out of their bank account, and they've already set that up and established that.
I like that. And just tying this back to an M&A perspective, usually if you're a seller and you're selling your business, you might be wondering like what happens to the AR at the time of closing. What we most often see is the AR is included as an excluded asset, which means the seller holds on to all the AR that's been generated up until the point of close. So from that perspective, it doesn't really impact the amount of the assets that the seller is going to get out of the deal. They're keeping their own AR. But where it does come into it a little bit more is the buyers will often ask for an aged AR report, and they want to understand from a general perspective how good are these clients at paying. So even though the seller retains the AR, the buyer wants to understand what it's going to be like, post close for them. That's where it usually plays into a little bit more. So yeah, just wanted to mention that this will be scrutinized by buyers during due diligence.
And Devin, I think your point there is we're establishing a difference between the lump sum on the balance of the accounts receivable of what is at the end of the contract, or when the contract begins, of this is the asset that I'm going to keep, and then also the ongoing process of making sure you're getting paid. And I think that's where I'm not necessarily focused on the amount of money that's sitting out there. I really want to focus on getting that system, that flywheel of accounts receivable moving. And yeah, I'm sure at the end of when it's signed, it's going to be a different that's a lump sum amount. I'm focused on primarily getting that system moving so that you are paid, and so the prospective buyer is also paid very quickly.
Yeah, and have clients used to like train to pay regularly. Because I mean, obviously, if you're a buyer, you're not gonna ascribe as much value to a client that is paying, consistently 90 days late paying, as you would somebody who's paying regularly and on time. So, um, okay, well, let's move on then, and we can discuss KPI dashboard standard COA. So, talk
So
to me a little bit about
yeah.
the chart of accounts here.
Yeah, what I mean, okay, so if you really want to put people to sleep, start talking about the chart of accounts. This is, if you're still with me, this is extremely boring stuff. And again, I don't want to talk about accounting. I want to talk about your business, and I want to talk about you building your business. You have to use accounting though. And when we look at the best clients out there, the best ones that we work with, they understand their business. They understand the industry. They don't just understand software and cyber attacks and security, and they understand how to communicate that information. And the way people communicate this is with a key performance indicator, which is also called a key predictive indicator, sometimes called a key predictive indicator. In this sense, I'm using KPI as a key performance indicator and a chart of accounts. That's what the acronyms there stand for. The way that you get detailed information, industry that speaks the language of the industry, so that when you show up at a major industry event and you're talking to everybody around and they say, what's your EBITDA? You know exactly what your EBITDA is. You know exactly what they're talking about. You know what your growth, what's included in your gross margin, and you can speak to that. You have an idea of what they're looking for. Again, accounting is a language of business. I don't want to put you to sleep here, but accounting is really about understanding what the language is. So when you speak the specific language of let's say it's a dialect. It's not necessarily a language of MSPs, but it might be a dialect. When you understand that, as Devin mentioned, as you mentioned earlier, Devin, software, the margin on software, the margin on hardware, the margin on services, they're all different. And unless it's being communicated in a way that is dissecting that and communicating each one separately, then it's not as useful to a buyer or a peer group or um, any benchmarking service. It doesn't make a lot of sense to do that. So in order to put together your key performance indicators, you have to be using a similar chart of accounts, and the industry already has this. And so, Devin, I probably spend too much time just saying some obvious things, but I run into people all the time that don't know that there are these benchmarks out there and what the industry is doing as a whole. There are some people out there who have done an enormous amount of work and collected information, excuse me, collect information on the present on a quarterly basis of what people all over the world are doing and how they are segmenting their business. And you can compare yourself to them, but you have to put it in a way that you can get to that point where you can see how you're doing in comparison to everyone else. And that is all dependent on putting together a chart of accounts that can measure your key performance indicators.
So you mentioned EBITDA, and what would be some other KPIs that you tend to focus on that are the most common industry benchmarks?
Yeah. Um, The first one that I would say is your gross margin. You have to understand what you're selling and how much it costs to sell that. That's your first one. And one of the first things that you didn't ask this, Devin, but one of the first things that I look at is whether or not the labor is going in above the gross margin or below. Is it expensed or is it part of a cost of goods sold? And that is, it's a litmus test for me to see how serious and how much work this client has been understanding their business. So if you're putting your labor in underneath the gross margin, if you're just expensing all your labor, that's not going to give you your gross margin, an accurate gross margin. And that's one of the first things that I'm looking at. There's a whole host of ones I'm looking at where your just your how many months of cash do you have? What's your current ratio? Are you able, how safe are you operating, and how closely are you how close to the edge of the cliff do you operate your business? So that's one of the things that I'm looking at. But I'm not a buyer and I'm not representing buyers. I'm just an accountant trying to get you the information that you need to run your business.
Well, thanks. That's helpful, and some definitely good some good considerations there for buyers. And okay, so next one here is disciplined close cadence. Uh, talk to me about this one, Paul. What in your mind, what makes up a disciplined close cadence?
Yeah, now we might, Devin. I just want to make sure we know what closing the books means. There's an accounting term that says close your books, right? That's the first bullet point right there. What does it mean to close your books? There's two types of close. There's a soft close and a hard close. And a hard close is you print off the financial statements, you give those to your accountant, they make some adjustments. They make those adjustments before the tax return, for example, is filed. And once they file the taxes, you don't go back and change anything. That's a hard close. Nothing can be touched before then because the IRS or your government agency has already, that's what they have recorded. And so if you change something, you have to go change it anyway. You have to change it back, excuse me. That's a hard close. There's a soft close, which says, I'm going to close out my books, but I still leave the room open. I leave the door open if I have something in the previous month. Like let's say I receive an invoice that is a month and a half after it's dated a month and a half ago. A soft close, you could go back and change that. Well, if you change that, it's going to impact all your financials. So what I mean by closing your books means all of your reconciliations are done. Again, if I lost you with that word, a reconciliation just means you agree in your accounting files with what the bank agrees with. What has cleared the bank and what they had is what you have in your books. And it's not going to match perfectly, but you're at least going to reconcile. You're going to compare notes with your bank, or compare accounts in this case, and you're going to agree that your books line up with what's meant in the bank. Now, again, if you're still with me and you're not asleep yet, checking account, saving account, clearing account needs to be reconciled. Your clearing account, if you are using an accounts receivable clearing account, you will get into big trouble if you don't reconcile that. And I'm speaking from experience here. Like this is a big deal. You want to make sure you do that because that's your AR and that's your relationship with your clients. You want to make sure that is cleared out every month. Checking account, credit card accounts, all of those need to be cleared and your loans also need to be reconciled. So you're going to reconcile everything on your balance sheet, all of your accounts on the balance sheet, and you're going to look through your profit and loss to make sure that there is no big, ugly transactions that can't be easily explained. That is generally closing your books. And then a best practice in this is to set a closing date password, which indicates that nothing before that date can be changed in your accounting file. That's the best practice. And you hold that password somewhere where no one can get to it, anybody into your files, and you don't change anything. That is the absolute best practice, where you are reconciling every loan, credit card, savings account, checking account, and clearing account on a monthly basis. And your books are up to date. That is a monthly close and a disciplined close. Most people, Devin, I don't be interested to hear your experience on this one, but I meet some people who are closing it by the 5th of the month, some people by the 10th of the month. We normally go by the 15th of the month. Those are what we are looking at doing, but getting those things closed on a monthly basis, just like clockwork, moving that flywheel, just spinning it around.
Yeah, and I'm gonna tie it back to M&A here again. So if you're in the seller's seat, having that practice already in place is going to be helpful, because one of the things that buyers are going to want is updated financials as the transaction goes along. So having those, consistently provided, and on a regular cadence is going to lend a lot of credibility. So getting that in place before selling is certainly beneficial there. Um, so yeah, but I think it makes a lot of sense to me. I like the idea of the password protected
Oh
sheet
man,
too.
I that has saved us so much heartache, because one of the first things we do in our procedure of, if we're looking at a tax return, because I do taxes as a CPA, and the we look at the books, and we see if the tax return matches their accounting file, because your accounting file on 12/31 whatever year should match your tax return. If you go to your Schedule L, if you're a business and you're a S corporation or partnership or corporation, go to Schedule L. That's your balance sheet, and that should match what you have on your accounting file. And if you've changed it and your accounting file doesn't match your tax return, you have to go back and change it. Or maybe you have to have your accountant go back and do that. But that's one of the first processes we use. And changing the password right there will say makes so much difference on that, and it makes your life so much easier. And if not your life, then your accountant's life.
Yeah, and I'll just say too, that's one of the things that we often see during due diligence, right? Buyers request tax returns to verify the financials they've already been provided. So, yeah, I think that's good advice there. Okay, so let's talk about forward-looking planning. So, how does an MSP monitor cash flow in 13 or 12-month increments? How do they plan for growth, and how do they go about being confident in their hiring expenditures?
Yeah, I think they put this last because I had a conversation with someone recently, and I said, really, I've joked that I'm trying to make the accounting boring, and that's really what I want. When people get excited about accounting, that's never a good thing. And yes, if you're still with us, again, if you haven't fallen asleep yet, I use these terms like reconciliation and chart of accounts. What we really like to do as accountants is not necessarily do bank reconciliations. That's some pretty routine bookkeeping stuff. What's the fun stuff is looking forward. And if you're working with somebody like Devin to purchase a company, and you are looking at how to integrate cultures and running the company and making the management decisions, that's the fun stuff. You want to use the accounting to make business work, and that's ultimately the most enjoyable aspect of accounting. The reason forward-looking planning is the last of these five systems is because you can't do it until everything else works. And by everything, I mean, if you don't have good data, you can't factor out you can't flesh out what the cash flow looks like in the next 13 weeks, because you don't even have any idea what the last quarter looked like. This is I guess it's probably a very elementary point here, Devin, but um, if you don't know where you've been, you really can't factor out where you're going. So cash flow on a 13-week is more of a startup kind of culture, younger company or tighter cash flow. 12 months generally is it either a budget or a cash flow. Uh, we're putting scenarios in place that say, am I going to meet this? What happens if I hire this person? Do I have enough people? Do I have enough revenue? What's going to happen? How stressed am I going to be when I take on this client? Do I have enough people to serve them? How much am I going to make? Am I going to make enough money? Worked with a budget with a client of mine. We finished the budget. It took a little longer than I was anticipating. Let's say that, and we figured it out. We used historical information. We had a really good handle on where things were going to be, and the owner looks at it. He goes, "I'm not doing this job for that little money. There's no way that's enough money." And I think it was a pivotal. It was the first time he'd ever worked on a budget, and he put together with real information from historical. They have great information. Their company is very well run. They've got a controller in place that does a fantastic job, but they'd never done anything forward looking. And as we looked at the last 2 years of information to create the next 12 months, we looked at the owner looked at it and says, well, that's just not enough money. And I think that's the catalyst there to say, well, what is enough money? And if you're not happy with where you're headed, then you have the opportunity and a forward looking to say, this is what I want the business to look like. Let's make it happen. Let's pencil it out, if you will. Let's put it on a spreadsheet and say, what does this look like? And am I going to make enough money? Am I going to create enough value if by doing this that it makes it all worthwhile? And that's a personal decision, but you don't know that stuff until you don't know that information until you have it in data that you're staring at and you can see it real time.
Yeah, but if you look at that and come to the conclusion you're not making enough money, I mean, the obvious thing is maybe it's time for a price increase. Like when was the last time you increased prices? It's common to do it every few years, a couple of years, if not more often. And maybe it's time to do that, or maybe it's time to reach out to me and explore selling the business if it's not enough
Sure.
money on an ongoing basis. So, yeah, I can see why this sort of forward-looking planning can really be influential for some really important decisions. And yeah, so that's a good one. So Paul, that's the last slide, but I thought maybe I could just go back for a second, just so we could wrap it up with the flywheel here. So just do you have any closing comments on kind of all these aspects of the flywheel that we've discussed? What's the main takeaway you're hoping that MSPs take away from this presentation today?
Yeah, thanks for asking that, Devin. I don't want to get stuck. I live in the weeds, but I don't want to get stuck in the weeds. And I certainly don't want you to look at this and say, this is a webinar about accounting. That if you're still with us and you say that, then I didn't do my job. My job was to try to convince you that your finance function, the ability of the way that you manage the money and the invoicing and the system of your business is a central component to how your business runs and is to some extent, and you can correct me on this, Devin, is what your buyer is purchasing as well. Maybe not the exact accounting system, but it is part of what the buyer purchases. So if you can get that working better, your business is the one that benefits. And you don't have to don't overthink it on each. I've divided aspects of your finance function into ways that I can articulate it when I'm working with clients. These are certain segments that I encourage people to focus on. Like let's get our eyes around what does standardizing your chart of account looks like. Standardizing your chart of accounts can be a very overwhelming process, especially for people who aren't accountants. But what's the benefits? What are the payoffs? Where are we going? How does this fit in the big picture of the business? Not accounting. It's the business. Spend your time focusing on the business, and as a component of the business, the financial component of your business is one of those that will help. If you get that right, it will continue to pay dividends in the rest of the business. This is not a talk about accounting. That's what I would really want to articulate, that this is really about getting your business right from the lens of the financial side.
Yeah, and I think, by implementing positive changes for these sort of aspects, you're going to get more interest from buyers. You're going to be able to demonstrate your profitability better. You're going to open up to different types of buyers, and you're probably ultimately going to get a higher valuation out of your business, because it's going to be obvious that your business is mature, and you can demonstrate the profitability by service line. So just again, from an M&A perspective, I think that's my big takeaway, and I think there's a lot of value here. So, Paul, thanks so much for being on the webinar today. Very informative, and I just want to thank anyone who's joined us and listening in today. If you're interested in getting in touch with us, you can email info@thehostbroker.com. And Paul, we'll put your contact details in the YouTube description here. But how can people find you?
Yeah, best way is through our websites, redearthcpa.com, redearthcpa.com. I'm on LinkedIn, or we're on LinkedIn as well, and you can reach us through that. So any number of those formats.
Well, Paul, thanks so much.
Thanks for
Talk to you
having me,
soon.
Devin. I appreciate it.
Thank you.